Investors who have large concentrated stock positions and need to diversify their portfolio have a pretty difficult decision to make. They can either sell and pay a hefty tax bill, or they can live and face the risk of single stock positions. But what most people don't realize is that there's actually a third way, a relatively unknown but actually pretty old and legit strategy that can help reduce risk without triggering an immediate tax event. Today, we're going to go over exchange funds, why investors may want to consider them, how they work, their pros and cons, and who they are for. Let's begin by explaining what exchange funds are. Exchange funds, not to be confused with exchange-traded funds, are private vehicles where pools of investors with concentrated stock positions can come together to form one fund that aggregates all their positions and then divvies them up among its members on a prorated basis. So let's start filling out our pros and cons list. The first pro is that they are diversifying investors' portfolios. Secondly, and probably equally important, they are doing this in a tax-free manner. Meaning this transaction, if it adheres to certain tax code rules, is not considered a sale, merely an exchange of one asset for a diversified portfolio, hence an exchange fund. But the question is, why do this in an arguably more complicated manner than simply selling the stock and diversifying? Well, let's see how the math would work out if you have to pay taxes versus when you don't have to pay taxes. Let's say, for example, you bought $10,000 of a stock that appreciated to $100,000. So pretty good stock pick. At a 20% tax rate, selling would mean that your portfolio would now be $82,000. Let's say that if you diversify this portfolio in a cheap US core fund and it compounded at 7% for the next 10 years, you would get about $161,000. That's not bad. But what would happen if you would have instead diversified via an exchange fund and then earned a 7% return? In that case, you would have an ending value of about $197,000. That $36,000 you lost has a name. It's called tax drag. By paying taxes now instead of deferring, one not only loses what was paid in a tax bill, but also in what that principal would have earned for years to come. Let's add that to the pros columns. You get to avoid the tax drag associated with the sale of assets. Fair enough. Now that we know why exchange funds are helpful to those with heavily concentrated stock positions, let's explore how they work. Exchange funds have certain rules and regulations they must adhere to in order for contributions to be considered tax-free exchanges. First off, investors in the fund have lockup periods. In general, investors need to remain invested for at least 7 years before cashing out. Any less than that, and they risk potentially losing their diversification, since they could be returned their original investment. And they could also lose their tax-free exchange status, meaning that the contribution would now be considered a sale. Not to mention, there are likely some heavy fees involved. This brings me to the main con, and that is illiquidity. Exchange fund investors need to plan to make sure that they do not need the funds for at least 7 years. Now, let's say that you did invest in an exchange fund and now you're locked up and you need some liquidity. Thankfully for investors, some plans may let them borrow against their position, but that may come with interest charges, fees, and other risks. So now that we know all this, let's review some other details to find out who exchange funds are for. A typical exchange fund will consist of about 80% in the stocks contributed by investors and about 20% in illiquid assets. Usually this means real estate to achieve equity-like returns and also get some rental income for liquidity needs. Now, I know what you might be asking, why 20% in illiquid assets? Well, this is done in order to adhere to the tax code and look more like a limited partnership, which that's what an exchange fund is anyway, and less like a mutual fund, for example. Exchange funds also have some investment objectives behind them. So for example, tracking the market or a specific index. And because of this, exchange funds may or may not accept your contribution, as some stocks may already be oversubscribed. I will put this in the cons column along with the fact that you need to be an accredited investor, meaning you're either a high earner or you have a net worth of $1 million or more, with some exchange funds requiring that you have a $5 million net worth. In that same vein, investors need to contribute a considerable amount, and depending on the exchange fund, this could be anywhere from $100,000 to $5 million. Lastly, there are fees and expenses that you likely have to pay for if you decide to participate, which are generally much larger than if you were to invest in a vanilla market tracking mutual fund or ETF. At redemption, investors will receive a prorated diversified basket of stocks and preserve their original cost basis, all without a single taxable event. So there you have it. If you have a heavily concentrated stock position, an exchange fund might be one of the only solutions to diversify your portfolio in a tax-free manner. As always, make sure to consult with a tax professional to see if an exchange fund is right for you. Here at Alpha Architect, our goal is to empower investors through education. We're an asset management firm that focuses on delivering affordable alpha to our clients. If you want more educational content like this, head to alphaarchitect.com. I'll see you there.